discussing how contractors can finish strong and finish well when they decide to exit their business. This is the Contractor Succession Podcast.
Hello, everyone, and welcome to the Contractor Succession Podcast, where our focus is on helping contractors finish strong and finish well when they decide to exit their business. However, we also discuss how contractors are helping their business so it is not only valuable when it is time to leave, but also great to operate on a daily basis. My name is Marty Wolf, and along with my partner in Contractor Succession, Mr. Scott Good, we will be your hosts for the Contractor Succession podcast this episode. So, Scott, back for another podcast, huh?
Looking forward to it, and hoping we can have some great conversation with some wonderful guests.
Oh, well, I know we are. So, let's introduce these guests. So we have Cole Harmonson and Casey Conlon. Their company is Dare Capital. And I'll introduce Cole first. Cole Harmonson. From the very beginning of his career, Cole has recognized the transformative value of factoring and asset-based lending to manage cash flow for growing companies without impacting equity. Important point. Did a few other things in the middle of all that. I'll skip over that, Cole. But Cole took the leap into entrepreneurship and first company, and now he is the co-founder and CEO of Dare Capital. Casey Conlon. Casey is a client advisor for Dare Capital. He has a unique background, having served as a leader and executive in multiple companies across multiple industries. Again, there's a lot about Casey in his bio. I'm going to shorten it up, Casey. But Casey began his career in finance with Cisco Systems, Cisco Systems. In his spare time, he serves as a mentor for people in recovery in Austin and for the prison entrepreneurship program. Very interesting. Interesting backgrounds, guys. So you are with Dare Capital. So I guess the maybe the obvious way to start, and I'll start with you, Cole, is let's talk about who is Dare Capital. And maybe I'll say this first. As I looked at your website, it says in the who we are on your website, it says we're the financial partner you've always wanted on your team. So Cole, tell us more about Dare Capital.
Yeah, thank you very much for having us. We really appreciate the opportunity. Dare is a independent finance company that makes asset-based loans. We buy receivables. We partner with other white label sources, and we also do construction finance, which is about 50% of our business or so. So in general, we provide working capital for companies that they go to the bank and the bank says, come back when you're ready. We really, really, really want your business, but not now. When you actually need it and you're growing your company and scaling your business. And I say that with much love to all my banking brothers. I've worked at 5 different banks during my career. But we got started, and I got started in this business at a bank, at 2 different banks, doing this inside of a regulated environment. So we're here to help companies that are mostly, call it less than 50 million or so in revenue. So on the smaller side, in our construction book, we mostly have subcontractors that are in there. We don't really work with generals, people, unless they're performing their own work. But that's there's a high level if that's good enough.
Yeah. Well, I'll ask Casey you the same question. You can give us some, maybe add on to what Cole said. So who is Dare Capital? Maybe from your perspective, tell us, maybe go a little deeper on what he shared.
Yeah, I mean, I think the who we are is different than the what we are, right? The what we are is the lender. We can lend off accounts receivable or your invoices. As Cole said, we can purchase those and advance it against them. I think the who we are, and as the website had mentioned, the financing partner you need. It's really at a deeper level where we try to connect with the entrepreneur that's at the table across from us, or now in 2021 on the other side of the video call. As Cole alluded to, we are an asset-based lender, which most asset-based lenders would tell you there's kind of three legs to the stool that you'll balance a client on. You have your collateral, or the assets you lend off of, the company, and then the entrepreneur. And they typically stack rank that: asset first, company, and then the person last. At Dare, we flip that upside down and go the person, the business, and then the collateral. So we're really trying to have that true connection, be with our borrowers through the growth times and the high times, but also have their back when they need it. And I think that, having been in other industries, as you read my background, is a lot more rare in the lending space. So that's more who we are, I think.
So Cole, back to you. So you're a co-founder. So tell me about your other co-founder, and you two got together. And how long have you been in business? Number one, let me answer that question.
We started the company in November of 2019.
Okay, so you co-founded along with a partner, and so what was the overriding? Which you told us what you do, kind of, but did you just see a huge need in this space? What really kind of drove you to do that along with your co-founder?
That's a great question. So Deborah Zukonik, who is our chief credit officer and is someone that I've known since the mid 90s, has been in the construction space actively for approximately 40 years. So she's been in and around this business for a long time. And I sold my last company, Far West Capital, to Central Bank out of Houston, and went to work for them. And their credit box was a little bit small for me. And also, Deborah, at the same time, serendipitously, was selling her last business where she was chief credit officer. And she called me and she said, "Hey, let's do this thing." And we're really like the Brady Bunch of factoring. So she brought some of her team, and I brought some of my team, and we have employees from Idaho, North Carolina, Texas. So we're a fully remote business, and we really got started by buying a portfolio of assets that we that we were selling. That's another story. She was selling, and we bought some of those
Right.
assets back
Got it.
from the bank.
Got it.
Matter of fact, the reason why is because they didn't want to be in the construction space.
Ah,
So most lenders who do what we do don't understand the risks that are involved, or they do understand the risks that are involved, and
yeah,
they can't put their arms around them. And so that was one of the
yeah.
reasons that we started, and sort of the the why behind it all was that we both had complementary skill sets. Slash, we also were focused on the same markets. We had done participations together. We served on 3 boards together, so we've known each other for a really, really long time. And that's
So
go
go
ahead.
ahead. Okay, so my buddy Scott is in the construction space. So Scott, get ready for your follow-up question to that. But in the meantime, while you're thinking of that, you can find more about these gentlemen at darebizcapital.com. That is correct, right?
Yes, sir.
Okay, darebiz, B-I-Z, darebizcapital.com. So Scott, anything like you ask these questions, ask a question of these guys. We have a lot more to talk about, but for you,
Well,
go.
yeah, no, I can appreciate what Cole was saying, having been in that space for quite a while now, realizing that bankers do struggle with the risks associated with contractors, and some, in fact, most, uh, get very yippy about the lending piece of it. And you were throwing out the factoring thing. I've used it on a couple occasions. It's an interesting concept. What, just out of curiosity, what percentage of stuff are you doing from a factoring cash flow percentage versus, say, a purchase of equipment or inventory lending?
That's a good question.
Did that make sense?
It does make sense. I would say the overwhelming majority of what we do is based upon funding invoices for working capital. We do have a little bit of sort of materials finance inside of our portfolio, so it's ahead of making sure that the job is done properly, etc., and before we can fund on materials. So percentage wise, I would say it's upwards of 90% just on the receivable side. The equipment stuff that we do, or any other advances on any other assets that we do, like inventory or real estate or machinery and equipment, are always done in conjunction with a receivable facility, if you will. That could be a loan. It could also be just straight buying of invoices.
And I can understand
Okay,
why.
Scott, answer that question.
Yeah, well, yeah, and then also just the subcontractor piece of it. As a second or third tier subcontractor, oftentimes we're waiting, 75 to 90 days, especially on publicly funded work, to get paid. And so, having to pay our payroll, and then also having to pay for materials. Sometimes, we're a pay when paid for subcontractors that work for us. I'm a mechanical contractor, so I have sheet metal and insulators, and those guys are even further down the food chain. So I understand the necessity to try to focus in on that sub world.
Yeah, and if you sort of think about the smaller contractor as they're growing their business, our experience most of the time is that you have a tradesman who's very, very good at executing and doing whatever he or she does in that particular world. And for whatever reason, they decide to start their business, and they get out and they win a few jobs. They have some learning experiences along the way. And so what we do and we created some technology around this as well, so we can keep up with all of the things that we deem them non-negotiable. When you're growing and trying to execute your business, if you want to stay in long term and you want to go to that next level. And really what we think about is, how do we make our client actually a better client? And at the end of the day, when they leave us, they'll have known some things that they didn't know before. Maybe they will certainly be able to keep up with what they're doing much better, because our system requires it. And for the most part, it's not anything that most people are probably not familiar with, but it's all in one place. And if you could just think about sort of the top of the project, from a project risk standpoint, to the GC, and then on to the execution of the contract, and then below that you would have any kind of lien risk that we can help them identify that is mitigated. So if you just think about risk and what the contractor is doing at each step of the game, what we're trying to do is to help our client to manage that risk and to also execute on what they're doing. So if they come to us and they're not so good at paperwork, when they leave us, they will be very good at paperwork and also doing what they do for a living, whether that's concrete or whatever the particular trade is. So that's kind of a high level of what we actually help them execute on. We keep it all in one place. We actually help them keep up with their WIP as well, just to make sure that there's continued profit in the job. And we'll look at that on an ongoing basis and be able to tell the client, hey, we have this particular construction company that's paying our other client at 60 days and you're getting paid at 90 days. Is there a reason why? So we try to give them information that they may have had before, but our particular insight into how they're running their business and what they're doing on a day-to-day basis is going to be much better. It's going to be much more organized and kept up with. Our team is, I think the minimum amount of experience in the construction space is 15 years. as far as the teammates that are actually handling these kind of relationships. So, whether they've, you talk about any particular stage of it, including when things don't go as planned. And as you guys know, there's many times in this world where things don't go quite as you plan. I've heard
Yeah.
it said, "You plan, God laughs," and you know things happen, and so we're able to help our clients to adjust to that and continue to have reliable cash flow. And as a percentage of their cost of goods sold, if you looked into it and you saw all the things that we do, saving our clients money, time, energy, and effort, call it 2% as a fee. It's actually a pretty small percentage to pay for. Oh, we'll file your liens for you. Oh, we'll keep up with the credit risk on every single project that you're on. We'll keep up with making sure that in this particular job you're going to get paid no matter what if something happens on the job because of the way that we manage our verification process with
So,
our debtors. That's a lot of talking by me.
no, that
I
was
was not
perfect, though.
succinct.
I want to make sure everybody knows that was Cole Harmonson, and he is, as I've already mentioned at the beginning, the co-founder and CEO of Dare Capital. Also with us on the screen is Casey Conlon. He too, of course, is with Dare Capital. Their website is darebiz, B-I-Z, darebizcapital.com. And of course, you see Scott Good if you're on video, my partner in contract of succession on this call. So I want to bounce over to Casey. So,
Tough to follow
Casey,
that up, Marty.
well, I'm going to give you an opportunity to do that. So
Let's
you
just
are
talk
a
about
client.
Casey's
You
hair.
are
We could just focus on that.
you are a client advisor. So I'm assuming you talk to clients and or prospects.
That's right.
And so I'm sure there's no normal day, but kind of run me through a couple of phone calls you might have gotten in the last few days or weeks. What are people saying to you when they're calling? What's the conversation like? Talk to me about that.
Yeah, great question. So, conversations I've had the last few days is a very broad scope. I'll try to rein it into the ones that are more applicable to this setting. But usually, you know, um, in the non-bank lending world, we're primarily referral source based for our leads. So I'll have a call with, say a banker or, a CPA, for example, who has a client that they think I should talk to. Um, in the last week, I've had two conversations with businesses, and this is kind of, broad strokes, the type of some subcontractor that we help. It's that group, Cole alluded to, that his banking brothers say, hey, we like your business, just not right now. And both of these businesses are less than 3 years old, so they don't really have that track record or history from a financial reporting perspective. They're both
Yep.
experiencing, or one's experiencing high growth. The other one was coming off of a down 2020 and looking to grow this year. So they're looking at their working capital and the inability to get paid in a timely manner as a inhibitor against their growth and ability to hit their goals. So one is doing about $2.5 million in revenue. They're a commercial landscaping, uh, working for general contractors. Another one is a steel fabricator doing a bunch of 7-Elevens here in Texas. I learned that in Central Texas, 7-Eleven is making a big push, and they're doing all the kind of like steel fabricating for those projects. So they're at, I think, 3 million, hoping to go to 5 million this year. So, close to
Mm-hmm.
doubling their business and looking to figure out how to bring forward that cash flow to help fuel that growth.
Yeah. So both of you have talked about what I think are distinctive things about Dare Capital. Cole, I'll ask you first. What I keep hearing, and I guess I'll ask you to correct me, but what seems to be very distinctive is I'll call it patient capital. Is it okay to refer that way? And if it is, tell me if I'm accurate and maybe go deeper on that.
Yeah, I think that's a great way to describe it. I think sometimes our patience is forced, but it's patient nonetheless. And again, as you know, we really try to focus on folks who are the execution part is not an issue, and I'm sure you guys know what I mean by that. If there's other problems to solve, we can solve those problems. We can help solve those problems by finding other capital, by providing the capital ourselves. Or if it's an execution issue, and again, I think that's where we really try to hone in and help our clients. Again, I think we're unique and different in that A, we like this space, B, we've been in it for a long time, and we've sort of been there, done that on many of the issues. The word that rings out in our heads all the time, and it's the reason why we created the technology and spent all the money and energy and effort to do so, is how I think most folks who have approached this business have looked at it has been to say, hey, there's this batch of collateral that we're lending on, and that's the most important part. And for a lot of reasons, they're not wrong in that, and that's how most people do it. I think we come at it from a perspective of we want to be able to look back on the outcomes, and that's where we get many of our clients is from other clients who refer us, and they say, or they stick with us. For an example, we have a client who has been in our portfolio with we're brand new, but some of these assets that we bought were not brand new. They've been in our portfolio for about 15 years, and this is a contractor that works for some of the largest names in the country that you've probably heard of in the oil and gas space. And they could have gone to a bank many, many times. Having gone through some cycles and having seen, the ins and outs of the way banks treat this type of capital, which is, again, and I don't want this to be a diatribe against banks. Banks are regulated, and there's a reason for that regulation, and there's also a reason why the United States has the banking system that we do, which is the most reliable one in the world. And it's because the regulators make sure that the assets that are held on the books are like actually good assets that we're funding with our deposits. So I have no problem with that, except I think they miss the point in some of their marks that they look at in their book, and they say, if it doesn't meet this criteria, well, then it's not a good asset. And over many decades, we've seen that to actually not be true, because if you have your hands on it properly, and if you are treating your clients in a way that says, we want to get a profitable outcome for the people that we work for, which is our clients, not just ourselves, then we're going to focus on those outcomes. And one of those non-negotiable things is measuring the relationship. So you've heard and you see on the side of banks, every single bank says the same thing. We're all about relationships. We're all about customer service. We're all about doing these things. And you ask them, well, how many of your customers are satisfied? Well, I mean, a lot of them. I'm not sure. I'm not sure exactly how many. And so we started putting some metrics around that, and it
Wow.
not having it be just about whether or not you're in good standing or not. It has to do with where the business is heading. So, as you can guess, that requires sometimes many difficult conversations. And if we see our client performing work that they're not making money on, or performing work that they're having issues getting paid on, or performing work for contractors that we know that make it difficult, especially for the new guy on the block, then we're not afraid to say no, and to help our client, to guide them into a place where, now, we're never going to tell them what to do, but we're going to tell them what we will and won't finance. And we also say, look, at the end of the day, if you're not making money in this business, this is not like Tesla or all the tech companies that you read about, on the NASDAQ. They're companies that you must produce a profit in order for you to stay in business.
Yeah.
And again, we're really good at identifying those things proactively. So that became kind of our mantra, was proactive, proactive, proactive. And what we learned was we had a bunch of data in our system. And if you spent the weekend combing through it all, you could find what you were looking for. But we built a system that gives you all that information we just had our portfolio meeting this morning, and we're across the country asking questions
Yeah.
of each other
Yeah.
about what's the right next step to take with the client.
Yeah. Scott, there's probably been times in your life as a mechanical contractor or HVAC guy where you would have loved to have called their capital, I think, huh?
Yeah. As I'm sitting here thinking back through some of my travails with banking relationships, yes, 100%. Hey, a question for you, and maybe Casey, you can answer this one. As I was thinking about the kind of the base of your work as a percent, it's kind of a two-part question. The first one is there a percentage of the clients you deal with that are doing public versus private work? And the second part of that is, do you have a different process to analyze the risk in dealing with public versus private?
In terms of public and private, you mean like public being like an infrastructure the state of Pennsylvania is building a bridge versus an office building?
Correct. Yeah, it's being publicly government funded.
Got it. Yeah, and Cole probably can answer better the percentages because he mentioned a portfolio meeting this morning, but we have a different meeting for the team that I'm on, so I'm not as privy to those stats. I would tell you in terms of process, I mean, we're going to underwrite all of our deals in the same manner. But if you're looking at obviously a government backed, whether it's a bonded job for a school district or, infrastructure building a bridge versus, in a private job, if you came in last year, there was a boutique retail center that was being built in New York City. Height of the pandemic, we obviously have a little bit different faith in that job, one being funded throughout the project or something that we want to be financing, right? So there's a little bit more certainty usually with the public works compared to the private, but everything still goes through the same credit and underwriting process.
Okay.
Cole, anything to add?
Yeah, I mean, in terms of, I would say it's probably 80-20 private to public.
Okay.
In terms of what we're working on. We, as Casey mentioned, bonded work, where if our client is bonded, that obviously knocks us out of the game because the bonding company has rights of subrogation, and basically we would be doing it unsecured. It doesn't mean that we don't ever do bonded AR. We've done a few here and there, but that's most of the time it's gonna knock us out in terms of the type of collateral that we'll be able to finance.
Well, believe it or not, half an hour has already passed. We could go for a long time. Fascinating discussion in our space, which is obviously contractor succession, which we deal with clients that are not only wrapping up their business in the next year, 2 or 3, but we've also spent a lot of time with clients who know that they're going to transition eventually from their business,
Yeah.
alive or dead. They're going to transition out, and so we spend a lot of time with those clients also, but always with the thought that, hey, run your business like you're going to transition over a period of time, and that's the way we approach things. We have clients that have been with us for 3 years and know they're going to get out, but they're building it to be a great company, just like I said in the introduction. So we could go on for a long time. Cole?
If I can just add
Sure.
something in that regard, is many of our clients are in the growth phase, but we do have some that are considering selling, and so part of what we do also is get them ready for that, and we do that by naturally with our process. We require financial statements. Sometimes we require audited financial statements. Sometimes we introduce investment bankers to our clients who want to sell, and they're doing things, like making sure all of those things that I mentioned before, which I won't go on and on about again, but all of those things that we are looking at before are on the due diligence checklist for a buyer. They want to know when they're taking over these jobs. I would also mention that we can help in terms of if you have a buyer and they want to buy your company, a lot of folks won't finance. They're going to need working capital with the purchase, and so I think we're a good option for people who like the business and understand what it means to be a very successful contractor. So,
Perfect. So let's wrap up. Again, our guests have been Casey Conlon, Cole Harmonson. They are with Dare Capital. And again, their website is darebizcapital.com. That's D-A-R-E, biz, B-I-Z, darebizcapital.com. I think anybody in the contracting space, if they have any needs, anything that we've talked about today would bode well by going to that website and making contact with these folks and learning what they're all about. It's been an exceptionally valuable discussion for our client base and for our prospects and for the people that we talk to every day. So, gentlemen, thank you so much for being part of the Contractor Succession Podcast.
Thank you guys for having us.
Thank you.
Thank you for listening to the Contractor Succession Podcast. You can learn more about us at our website, contractorsuccession.com. You can also find us on Facebook, LinkedIn, and Twitter.